Morning traders, it's the 14th of December. We are Signal Centre Talking Bull. I'm Joe, joined by Steve this morning. How you doing, Steve?
Not too bad, mate. Thank you. How are you?
Good. Yeah, all right, thank you. Battling the elements in my office.
Oh, I bet. Yeah.
Yeah, got the heating on, got the woolly hat ready, wrapped up warm.
Yeah, nice.
All good though. Cool, right. So interesting day yesterday. Big volatility as we expected, and yeah, it was quite fun, but not really any of those gains sticking at the minute that we saw in the equity markets in particular. And we'll come onto those charts shortly. But before we do, let's run through the latest headlines just to bring everybody up to date with what happened yesterday, and maybe what we can expect a bit from today as well. So, latest headlines: the German confidence edged higher yesterday. The German ZEW sentiment index improved to minus 23.3 for December from minus 36.7 in the previous month, and that was above the consensus forecast of minus 26.4. Then we had the all important US inflation number, which declined further. The prices increased 0.1% for November after a 0.4% increase in the previous month, which was below the consensus forecast of 0.3%. And year on year, the rate declined to 7.1% from 7.7%, and also below expectations of 7.3%. So, with that coming in below expectations, we expected to see a pretty substantial move higher in the markets. If you recall, if you watched yesterday, we were looking at the JP Morgan cheat sheet that they put together and how you should be playing it on the day on the basis of a 7.1% number. They had 15% probability attached to that and suggested that the market would move up by 4 to 5%. Obviously, there was a pretty substantial move, but not quite into those realms. It certainly didn't stick anyway. And on the back of that, US yields retreated on peak inflation hopes. The US inflation data sparked further optimism that inflation had peaked and yields moved lower, with the 10-year yield dipping just below the 3.5% level and the lowest reading for over 2 months. The US dollar also slid on the number, reaching 5-month lows on an intraday basis. Lower yields and hope for a less aggressive Federal Reserve stance triggered dollar selling, with the index slumping to a 5-month low before a limited recovery. But the fun doesn't stop there. Yesterday, we do have a key Fed decision today. They will announce their policy decision later on. Very strong expectations that there will be a 50 basis point rate hike, taking the overall rate to 4.5%. The latest set of interest rate projections from Fed members and rhetoric from Chair Powell will be crucial for expectations and market reaction. We've had some numbers out this morning as well from the UK. We've had the CPI number out here. The headline inflation rate declined to 10.7%, so still well above that we're seeing in the US. That's for November, from a previous reading of 11.1% and below the consensus forecast of 10.9%. Again, indicating that inflation may have peaked, but still at severely elevated levels. So let's take a look at how this is all impacting the charts over the last 24 hours. I would imagine Bitcoin got off to a pretty good, had a pretty good move yesterday on the back of improved risk appetite.
Yeah, it certainly did. It's definitely one of those risk assets now, and it reacts in just the same way now as indices, but a bit short-lived as well. Although it's still higher than we have been for a number of weeks now. Funny enough, it did stall in front of the 10th of November high, which is comes in at 18,150. Still just in front of there and reversed sharply. Also, you can see the 55-day moving average, this blue line which is coming down, that it also stalled there. So there's still plenty of resistance above, a big heap of resistance in the form of this Ichimoku cloud, and then we got the 100-day coming in at 18,730. So yeah, not bad at all. If we break it down maybe to an hourly chart, we can see the reaction on the non-farm payroll, CPI just here, 130, big spike up, moved from 17.4 to up to 18.1, so a good 700-point rally on the back of there. Then there's sort of like sell-off after that as we didn't get the follow-through that we were expecting. So overall, it's still, I suppose, slightly bullish, but I don't know what sort of fumes it's staying up there on. Gold, let's take a look at gold. Obviously, that is that reacted as well. Basically, it more reacted to the dollar weakness, which because normally when you do get the indices rallying, gold will generally go the other way. It's a safe haven asset rather than a risk asset. So we're through the 200-day moving average, which is positive. We're also through this band of resistance, which is up to 1810. We've got the double bottom formation formed back here, which has a measured move target, which we've mentioned over the last few weeks as well, 1844. So it looked well on its way there. Got up to 1824 yesterday before turning around, and we're now back within that band of resistance. So closed just above it, but only a fraction above it. So there's still a lot of work to do for me to turn mildly bullish on this. But if you look overall, you could draw a sort of like a weird shaped head and shoulders, inverse head and shoulders on this, where the neckline is around 1810. So 1810, the real, or 1800 to 1810 is the real sort of like level we have to break away from now. So the next sort of like week, well, I think this week we should sort of like get an answer on that. Silver continued its move higher with this inverse head and shoulders formation. That got up to 24.13. The measured move target is 24.92, so getting nice and close to that. Still looks pretty positive on the day, as long as we remain above the 23. Well, yeah, I'd say 23.15 level. As long as we remain above the 23.15 level on the day, then the momentum should sort of continue. It's been quite a nice reaction higher. Copper is still capped by the 200-day moving average and the spike high we saw on the 14th of November, up to 396. We got up to 392.70 yesterday, so a new high, high we haven't seen since the 14th of November, or levels we haven't seen since then. But that $3.96 to $4 area still offering some decent resistance. Overall, we are in a mildly bullish trend. We're above the Ichimoku cloud. We're above the 55 and 100-day moving average, but not quite above the 200-day moving average. And WTI crude oil continued the recovery towards the previous neckline resistance that we had, $76. We got up just above that yesterday, got up to 76.27. Two really positive days of price action. Wednesday today, so oil inventories out today. So let's see what that adds or not to this short-term bullish rally. Still looks to be a bit of a correction. We're still in a major downtrend at the moment, which is nice, as we're using a lot of oil and gas at the moment to keep ourselves warm. The morning doji star reversal formation in Brent crude is a little bit clearer on forming a bottom, but it still hasn't got up to the 82.35 level, which is quite a significant resistance formed by the previous support level from the 26th of September. And yeah, 81, around about 81.30 we got up to yesterday, 81.26 in fact. So hanging around the 80.70 level and bracing itself for the oil inventories out shortly. Natural gas remained elevated. There's still a bit of a gap on the charts, and price action did take a bit of a hit yesterday, giving up a lot of the gains from Tuesday's move higher. We're still in the Ichimoku cloud, so still overall in a bit of a downtrend. Still potential for this head and shoulders formation, although it is trying desperately to sort of take on these resistance levels here. Really needs to break above the 737 to 740 area to stave off the bear woes. That's about it from my side, Joe.
Thank you very much, Steve. Let's take a look at FX then and start off with the dollar index, as it had a pretty substantial move yesterday, as we expected. So the CPI number coming in less than expected, and as a result that meant that the dollar lost some ground. So we've still got this large top pattern that we're looking at on the daily chart, and apologies that more and more drawings and annotations appear to be making its way onto this chart, but still think it's pretty important. So there's a major support level I had here from this swing low that we posted on the 5th of December. That was at 104.11, and we actually closed below that yesterday on the daily basis. It was off the worst levels of the session, but we closed below this level, and we're still below it as things stand at the moment, although we are slightly higher on the day. So I expect gains to still be capped. I'm still really taken by this pattern and think that we are going to see lower prices, and therefore selling rallies into the neckline, or any sort of rally really into kind of this level here, 104.65, is likely, I think, to trigger more selling interest. My first downside target still remains at this 50% fib level, which is at 102.15, and then I'm looking for more fib levels on the downside, all the way towards the measured move target of this head and shoulders top, which comes in at 95.96. So still a bearish bias there on the US dollar. If we take a look at Euro US dollar, we can see that that again is attempting to rally through some pretty significant resistance levels. It closed above this 38.2% fib level that I've got in turquoise here. I've got a band of resistance that I've got drawn on the chart, and it didn't close above that yesterday. We actually hit the measured move target of this double bottom, or this bottom pattern that I've got measured on the chart here following the break of this bearish channel. So it looks as though it's coming up against some fairly stubborn resistance. We can also see some previous lows in this kind of region here, which we expect to act as resistance, and it has done. So going to take a fairly sizable move higher, and it may come today in the form of what the Federal Reserve have to say and in their comments later. But I think potentially a correction is likely here at some point. And therefore we could see some sort of pullback towards support around this region here, which is at 103.53. So I would be cautious about taking fresh long positions here on Euro US dollar. Looking at cable, that closed above the 50% fib level, which has been giving us a bit of a tough time over the last couple of weeks. So it managed to close above that yesterday, again off of the best levels of the session. We do have some previous lows in here that seem to be doing a job as resistance. If we go back to this phase here in August earlier this year, we can see some supports were formed here. We broke through that. That's not the one I was looking at. I was looking at this one higher up. So we've got some resistance levels here, which has done a pretty good job at preventing price from moving higher. So I think maybe this is another candidate for a potential correction. All in all, I think it looks quite bullish, but I don't want to be chasing it here. Certainly while these resistance levels are in the way, I think the preference for me would be to buy on dips, potentially towards 120.29, around this kind of region here, and then we'll kind of see what sort of reaction we get if prices can stabilize and form some sort of turning point and push higher, but into some major levels here, I think. Let's take a look at Aussie dollar. That's pushing higher, hit the measured move target of the inverse head and shoulders yesterday, and then stalled. We've got a 50% fib level quite close by. So again, all of these dollar majors appear to have or be running on fumes at the minute, really. They've had some pretty strong moves higher, but they're into some really stiff resistance levels now. So this is a real test for the bulls and the bears in terms of the dollar index as to whether or not we are going to push higher on these markets. I mean, obviously looking at that dollar index chart, I am looking for lower levels, but I don't think it will be as straightforward as we maybe think.
Nice.
Let's take a look at dollar yen finally. So that's trading in a bearish channel. This is probably the favored dollar pair at the moment for me. I would be looking to sell this into rallies while it remains within this bearish channel. Still looking for lower prices. My target in the short term is for a move down to 131.48, where we've got a major level of support. So I think that's probably my favored dollar pair at the minute. Are there any other requests for dollar for markets?
Yeah, all based around yen. We've got Eng Depot wants to get your view on sterling yen, and Last Skins wants a view on CAD yen, thinking, highlighting a bearish flag on the daily chart.
All right, fine. Let's take a look at sterling yen first of all. So immediately I'm looking at this chart and I don't really see a lot of interest because prices are chopping around in here, as you can see. If we take a look at the shorter term, we can see that some resistance is forming around this region here at 169.09. So maybe in the short term, there are some opportunities to trade a small range here. The candle yesterday did actually do a swing failure. So we tried to get above this level. at 169.09. We did have a little bit of a look above before closing back below it. So that may indicate that we are going to see a swing back lower in the short term, maybe towards these levels down here at 163.02. So I'm not particularly bullish on that at the moment. Let's take a look at the intradays to see if there's anything of interest. This is the 4-hour chart. Let's just clear that drawing. So again, we're highlighting this range. We can take a look at the resistance level here. We can see that it had a failure above these previous swing highs at 169.09 and then rejected that and moved lower. So there is potential, I think, for maybe a move lower towards these previous swing lows in the short term, given that we saw this reversal yesterday. But ideally, I'd maybe want to be selling it a bit higher, somewhere maybe around here, 168.42, just to improve the risk reward of the trade. And if we can get that on and still believe that this resistance is going to do a job, then we can start looking for lower prices down towards this kind of support level here, which gives us a really nice risk reward profile on that particular setup. So my bias there would be for lower prices. Let's take a look at CAD yen and see what that's doing. Again, let's just go back to the daily and start our analysis there. So for me, this looks like it's completed a top pattern, and my bias would be for lower prices on this. So you could argue a double top has been formed here. So this being one of the tops, this would be in the second. Then we're suggesting lower prices following the break of this neckline here at 104.56. And you could also maybe argue we formed an even larger top pattern here, some sort of head and shoulders top. It's not a particularly pretty one because the right shoulder is all the way up here rather than down here at the neckline. But we've broken through that with an impulsive move lower on the 1st of December. And now this level is acting as resistance at 101.41 to 101.65. So yes, I can see the bearish flag looking something like that and indicating that we are going to get a continuation move lower. So yeah, fully in agreement that that looks bearish on the daily and we can expect lower levels. If we take a look at the intraday charts just to see if there's anything setting up here, we can see that prices are pretty range bound in the very short term. We've got swing lows in place there and we've got a bit of a range forming. So how would we trade this? Well, we can maybe try and sell a retest to the upper end of the range, or we could look to trade a break of this move and expect a continuation lower. And we've got the bias on the daily chart to confirm that. So that looks like a pretty reasonable setup for me as well. So nice spot there, Laughskins. I like what you're seeing.
Excellent.
Was there anything else?
One, no, that's that covers off the request so far. So all good on that.
Perfect. We're going to take a look at some indices now.
Yeah, let's take a look at some indices because they had a pretty decent day yesterday for a while, and then
should I follow up on my S&P chart quickly before you go into the others? Just because I obviously marked that up, looking at the expectations of the JP Morgan trading desk. So they were expecting. Well, they didn't expect the 7.1% really because only associated a 15% probability and suggested that markets may move higher by 4 to 5%. So if we take a look at a sort of more zoomed in, this is where we were yesterday when we were talking. Then we obviously did have this big move up to the upside. So how much was that, in fact, from that point there to that high? So 3.6%. So to be honest, they weren't too far away, only 0.4% away from that sort of 4% up move that they suggested may happen. But obviously we did see a pretty substantial rejection of those moves higher. In fact, almost giving up every single pip that that candle put on between 10 and 2 o'clock yesterday UK time. So yeah, back to where we started with that by the looks of things, and I'm not sure if that's what you're seeing on the other charts.
Yeah, but pretty much, it's just sort of like looking really at what major resistances they ran into yesterday. The Dow seems to be, obviously quite entrenched in this corrective rally, and even spiked higher yesterday, levels we haven't seen since April, in fact. So everyone got very excited for a short while, stalled in front of 35,000, a bit of a psychological level. Also, we got 78.6% retracement at 35,182. So yeah, it's the spike higher, but then the candle on the daily chart is a bit of a shooting star candle, which is looks a little bit ominous, especially if we don't get any follow through today. I know we've got the Fed later, So let's see what they come up with. Um, yeah, I think we're expecting a 0.5% rise in the rates later. Any change from there would still be a surprise in my eyes. But yeah, levels to watch today. Really, on the downside, we got 33,400, so that's a long way away. And on the upside, obviously, really focusing on that 35,000 level. So the overall formation has broken through the downward trending resistance line. We've retested it, and it still looks mildly positive, I'd say. But yesterday's candle is a bit shaky. Funny enough, Nasdaq remains below its downward trending resistance line, and in fact spiked high and actually pierced the downward trending resistance line. That was coming in at 12,182. I went the opposite of Joe in the gun to head yesterday, and was playing devil's advocate and sold into the rally, looking for a higher CPI number just in case, but that didn't transpire. But it did stall around the resistance level and below the 200-day moving average. So this remains in a bearish trend and a shooting star candle to boot. So the levels to watch on the downside around about the 11,400 level. That's as level support and a pretty decent support line indeed. If we break there, then it opens up the downside. And there's a lot of work to do to get up through the resistance levels that we're highlighting on the chart here. S&P, as you can see, spiked through the downward trending resistance line and back below it, shooting star candle formed. So again, overall, it had not much change. I still am slightly bearish on the indices. A break below 3,900 would open up the downside, and yeah, resistance level coming in at the top there, 4,141. China 50 didn't really do a lot, sort of ignored the US numbers. Inverse head and shoulders still playing out, although we are moving a bit sideways over the last week or so. Resistance coming in at 13,300 and support down at 13,000. The Hang Seng finished quite positively on the day, but it's again back down below its 200-day moving average, or right at it at the moment, 19,700. In fact, got up to 20,127 yesterday. And again, the inverse head and shoulders, the bottom formation that we see currently. Nothing really to show on the Nikkei. Same sort of, well, price action in DAX, Germany 40 rallied into the resistance level and towards that double top level that we'd just broken through the neckline of last week, and rejected it and came lower again. So another sign that maybe this rally isn't as positive as we'd like to think it is, but we've still got the Santa rally ringing in our ears. So I wouldn't be too fast to go against this at the moment. The support coming in around about the 14,130 to 14,200 level, and resistance in the form of 14,676. And again, levels we haven't seen since June this year. So wow, what a sort of like decent rally we've had. The rally actually started in October, and it has been pretty exponential so far, this risk on rally. FTSE spiked into resistance. Don't know why that's blue. Let's make it red. And retreated as well. So support again, we're looking at 7,420. It got down to there at one point yesterday, or close to it. And this band of resistance that we've got above 7,515, all the way up, I'd say all the way up to there, 7,622. And then there's more resistance above it. So this impulsive move higher, I think we're seeing the first leg of a correction in FTSE. That about covers it there. Anything else people asking for?
Someone saying, how can we get your charts? So these are trading view charts. So get signed up, basically best in the business as far as we're concerned. They are, you know, as flexible and as, you know, user friendly as I think we've come across in our history of being involved in financial markets. So get yourself signed up. It's free up to a point, and probably if you're a beginner, more than enough to get you going.
Yeah, absolutely.
Okay, let's move on then to the gun to the head trades and have a look at what we did yesterday. So first of all, in terms of the challenge itself, we come up with trade ideas as if we had a gun to our head. What will we trade right now? When we come up with these ideas, we must have stops and targets. They're all placed at market and published to our TradingView profile straight away. The ideas will expire at 9 p.m. UK time or when the stops or the targets are hit, and we continue to monitor the progress of these ideas as we go along. So we're nearly 750 episodes in to doing this, so we've been doing it a very long time. We can have a quick look at the overall performance of these ideas. So we can see that on average, our win rates collectively are about 40%. So in fact, our default expectation using this approach is that we are probably going to lose money. But because we have a very strong risk reward profile on these trade ideas, we are up substantially in this period. And you can see that here. So we had a really nice start. Then we went through a big sideways period where markets were not overly volatile in the wake of the pandemic. And then we've seen volatility increase, which has been a good thing for us. And we've gone on to make new highs on the P&L and now in a little bit of drawdown, which is all normal parts of trading. So let's take a look at the trade ideas from yesterday. And we can see my idea first. I was looking to buy the S&P 500, expecting a weaker CPI number and for prices to move higher, and they did. But at 9 o'clock, I was actually only 0.2 R on side. So despite there being a huge intraday rally, there was no management of the trades. There was no moving up stop losses with the price. We just set and forget these ideas. And obviously in this instance, that wouldn't have been the best idea, but that's the game. But I'll take the win and move on. Steve was looking for the opposite. He was looking for the number to come in potentially higher than expected and for the market to be disappointed, and therefore he was selling NASDAQ. And we can see that that had a whopping move higher before actually reversing the whole thing back to where Steve got in. So we always knew it was going to be tough yesterday, given that there was substantial volatility expected. And today's no different, really, because we've got the Federal Reserve policy decision, but that's not out until 7 o'clock UK time. So we've got to try and get in and out before then if we can, Steve.
Yeah, not easy, is it?
It's not, no. You got anything up your sleeve, or do you want me to have a go?
If you're ready, have a go.
Right, let's go. I'm looking at dollar yen. Just mentioned it in my daily analysis there that this is probably my favored dollar pair at the moment, and it's trading in a really nice bearish channel. Price is rejecting at resistance at 137.65. We got a decent bearish outside day yesterday, confirming the weakness and therefore looking for lower prices within this channel. Ultimately looking for a move down to this kind of zone here where there is clearly major support. But if we take a look at the intraday chart, so looking at the hourly, we can see that maybe there is a double top formation in place here. We've got a top here from the 7th of December. Then we had these swing failures that were posted yesterday. We saw the big sharp move lower. Now we've got newly formed resistance, which was previously support at 135.60. And we've attempted to try and get through that, but it's been very choppy price action over the last few hours. So I'm going to try and sell this now. I'm actually going to give my stop a little bit more room than that. So I'm going to sell it at the current price of 135.43. The measured move of this double top comes in at 133.35. So that's going to be my target. And that gives me a risk reward ratio of 4.36. So I'll adjust that on here along with the stop. And if anybody wants to follow the progress of that throughout the trading session, please feel free to do so. I'll get that published up now. Over to you, Steve.
Yeah, I'm sort of like still, I'm in an R in where I'm going to go for. Do I believe in this break higher in gold or not? I mean, I don't know, Joe. I don't know. In fact, I've got to go with it. We're in a support band now. We've sort of like broken high yesterday, closed above the resistance level on the daily chart. We are above the 200-day moving average, which is moving lower at 17.88. So and we get very close to a crossover on the 55 and 100-day moving average. So we are, it's not a bad area to actually get long, even on a short-term basis. So let's just go with the flow on this. Stop just below the 1800 level, getting in at buying at 1809. I'll put my stop at 1799, and I'll look for a move towards 1839, which is just in front of our measured move target for this overall formation, the double bottom formation. Remind you of this. This is the daily chart. There's the neckline. There's the extension higher. 1844 is our target. So we're looking at getting on a move towards there. And why not? On the hourly chart, it all looks pretty decent. Yeah, stop is at 1799, target 1839, buying at 1809. That's it. Gold.
Lovely.
Looks
Gold.
nice and shiny.
Always believe in your soul. Right, so Steve's getting that published up. Let's get you prepped for the day ahead, because there are a few bits out today that we need to be aware of. Steve alluded to it earlier when going through the commodity charts, that at 3:30 UK time we've got the US crude oil inventory. So if you have positions in oil, this is something you need to be aware of, because it could create some volatility. Then we've got the main event for the day, which is the US Federal Reserve policy decision. That is at 7 o'clock UK time, and then swiftly followed by the Fed Chair Powell press conference. So his policy decision, with the expectations are very strong that we're going to get a 50 basis point rate hike, taking the overall rate to 4.5%. But really where the crucial part will lie is in the rhetoric in the press conference. That will be crucial for expectations and market reaction. So from what I've read, suggestions are that the rate hikes will be less aggressive going forward, but they are still going to come. We are still going to see higher interest rates in the US to try and combat this inflation number, because although it seems to have peaked and maybe slightly under control for the time being in the US, there is no guarantees that it's going to stop. So we continue that they're going to have to continue raising rates to combat that. So that will be interesting. Overnight, we've got the Australian labour market report. That's at 12:30 a.m. UK time. And then tomorrow we have a hat trick of policy decisions coming out in Europe. So we've got the Swiss National Bank, we've got the Bank of England, and we've got the ECB. So tomorrow promises to be yet another volatile session. Hopefully that was useful for everybody watching. Thank you for all your comments. Please continue to get involved. We love having your comments and helping you out where we can by looking at charts. That's it from Steve and I. We'll be back tomorrow morning.
Lovely. See you then.
Goodbye.